So, in today's market, you've got a real split personality. The data is telling us that a two-pronged strategy is pretty much essential right now. You have to hedge against some serious geopolitical risk, but at the same time, you can't ignore the raw power of tech fundamentals. All right, let's jump right in and figure out how to navigate this thing. What we're really seeing here is a classic tug of war. I mean, the entire market is being pulled in two completely opposite directions. It's this constant battle between massive global forces. You've got geopolitical fear on one side and this incredible, relentless tech optimism on the other. And this really lays it out perfectly. On the left, you've got the fear. The risk of a wider war with Iran is very real, and it's pushing crude oil up almost 6%. But then on the right side, you've got pure optimism. An absolute surge in demand for AI sent Oracle stock flying up over 9%. These are two totally different stories, and they're both dictating every single move the market makes. Now, just look at how this conflict literally tore the major indexes in different directions. The S&P 500, basically flat, went nowhere. The Dow Jones, with all its industrial giants, took a real hit, down over 0.5%. But the tech-heavy NASDAQ, it just barely managed to stay in the green, all thanks to that tech optimism we're talking about. This is the very definition of a divided market.
Okay, so let's dig into that first side of the tug of war, the fear factor. And to really get this, you have to understand what in the world is going on with oil.
This right here was the day's most alarming number, no question. A nearly 6% jump in WTI crude. This is your number one indicator of market anxiety. When this number spikes like that, it's telling you that investors are starting to price in a really serious global disruption. And that leads us to the big question, the one that had a lot of people scratching their heads. You had the International Energy Agency announce this massive, record-breaking release of 400 million barrels from strategic reserves. So why on earth did prices still shoot through the roof? Well, to get it, you've got to think like a professional investor. First off, 400 million barrels sounds huge, right? But in reality, it's only about 4 days of global supply. It's a Band-Aid, not a long-term solution. Second, the real risk here is a potential blockade of the Strait of Hormuz, which carries 20% of the entire world's oil. That risk hasn't gone anywhere. Third, the IEA themselves called it a temporary measure. And finally, you look at the VIX, the market's fear gauge, it's still way up there, over 24. That tells you the market simply does not believe this is over. And this quote from ING Analysis just nails it. You can release all the reserves you want, but you can't solve a military crisis with barrels of oil. So the bottom line is, until this conflict actually de-escalates, that risk premium in oil is going to stick around. Okay, now let's switch gears and look at the other team in this tug of war, this incredibly powerful and just persistent story of tech optimism. And there's no better example than Oracle's defiant performance. I mean, in a sea of red ink and uncertainty, Oracle was a beacon of green, rocketing up over 9% in just one day. This wasn't some tiny gain. This was a major statement from the tech sector. So what was the driver? Right here, this was the engine, a stunning 44% growth in their cloud revenue. This wasn't just a good quarter for them, it was an explosive confirmation of one of the most powerful trends driving the market right now. And here's the absolute key takeaway for any investor watching this. There's a powerful economic trend, this massive build-out of AI data centers. And it is so strong, it's basically operating on its own separate track, completely independent of today's geopolitical fears. This is a long-term, durable trend because it's driven by multi-year corporate investment plans, not by what's happening in the headlines this week. Okay, so we've got this insane market tug of war. What does a professional investor actually do right now? How do you position yourself? Let's break down 3 distinct playbooks you could follow. First up, for the conservative investor. If your main goal is just to preserve capital, the playbook here is pretty clear. Keep more cash on the sidelines than you normally would. You probably want to hold an energy ETF, something like XLE, as a direct hedge against that geopolitical risk. And you've got to be really careful with long-term bonds because if inflation ticks up, yields could rise, and that'll hammer the price of your existing bonds. Next, we have the balanced investor. This is really that two-pronged approach we started with. You maintain a dual focus, one foot in energy as your hedge, and the other foot planted firmly in the AI trend. You use what some call zoned thinking, buying into positions gradually instead of all at once. And you keep a very close eye on that 10-year Treasury yield. If it stays above 4.25%, that could start to put pressure on some of those high-growth stocks. And finally, for the aggressive investor, the one looking for those high rewards, this strategy is all about timing a pivot. You're basically positioning for the conflict to end, and you're watching for a key signal, like the VIX fear gauge dropping below 20. If that happens, you might look to sell that energy hedge and quickly reallocate into tech and other growth stocks that have gotten beaten up, like Affirm, which has been hit pretty hard this year. So, looking ahead, it's absolutely critical to know which data points are going to tell us which side is winning this tug of war. Let's really pinpoint the key risks and the indicators that you need to have on your radar. On the risk side of things, here are the top 5 threats I'm watching. Number 1, the absolute worst case scenario, a full blockade of the Strait of Hormuz. After that, we're watching for any sign that inflation is coming back because of those energy prices. We're also looking out for more failed government bond auctions, the VIX staying stubbornly high, and of course, any signs that the consumer is finally starting to crack under the pressure. And here's the calendar you need to watch. You've got producer prices, retail sales, and the next Fed meeting. That's the Federal Open Market Committee. But circle that last one, the March CPI, the Consumer Price Index Report. That will be the first official inflation number to show us the impact of this oil price spike. It is, without a doubt, the most important number to watch next. So, that brings us right back to the final and most crucial question. In this ongoing tug-of-war between geopolitical fear and tech optimism, and with the strategies we've just laid out, which side are you positioning for? Because the answer to that question is going to define your performance in the weeks ahead.